Numbers Man here on the 19th of April 2015. This is This Week in Economics, our commentary, big data supplement here, where we explore various items from the economic papers and pundits of the day. And a few studies occasionally we put in. We'll have more of that coming across. I'm looking at the Wall Street Journal. This is their weekend edition. And the headline is here, markets lose their footing across the globe. Usually we talk about macro economic policy and its global attention, various governments, in terms of either austerity or quantitative easing or accommodative economic policy. But we're talking about markets today, and this is a good way to start our coverage. And I'll just read a little bit of this. Stock markets from the U.S. to Europe to China took a beating on Friday. We'll get to this incidentally later. Fresh fears about Greece, wobbly corporate earnings with the Dow Jones Industrial Group's average giving up 3.23 points of its gain for 2015. Greece's international creditors signal they are losing hope that Athens will do what is needed to unlock bailout funds before it runs out of money. Prices of Greek government bonds plunged as concern increased about default and exit from the Eurozone, which many analysts believe would hurt European banks and further slow economic growth. The U.S. Secretary of the Treasury, the equivalent to the British Secretary of the Exchequer, said that the new government in Athens is running out of time to reach an emerging financial agreement. Not reaching an agreement would create immediate hardships for Greece and uncertainty for Europe and the global economy more broadly, he said. Finance ministers and central bankers from a group of 20 leading economies warned Friday about the uneven global economic expansion, expressing particular concern about emerging market economies. Adding to the worry, investors' uneasiness were worsened corporate earnings development in the U.S. by the car giant American Express and new trading restrictions in China that is much needed here. The decline highlights the volatility of global stock prices. This in itself is inherent in any global financial system. We have in these broadcasts talked about very uneven development within the industrial capitalist nations and, of course, emerging markets. To add on to this, let me make sure I get all of this article here. A7, where we need to go and get the rest. And then we'll get back to compensation, wages, etc. Officials warn Greece time is tightening. We just talked about that. Heading towards trouble. Greece's 10-year government bond yields, weekly data. I don't know if I'll have this, this graphic to present here. This is in the paper edition of the journal. And if we look at it, the negotiations over fresh emergency funding for Greece are likely to take several more weeks, while racing June deadline, the International Monetary Fund on Friday, as U.S. and other officials sound alarm. Greece has a progressive government that has stated that it will look after the best interests of the Greek people. And, of course, default is not out of the question. One has to comprehend the economic conditions that the Greek people have suffered. 25% plus official unemployment or redundancies there. And Greece is an internal economy primarily, except some tourism basically is how the money is earned there. Greek European creditors have expressed growing frustration with the new government, worried it won't do what is needed to unlock bailout funds before the money runs out. Well, if they run out and go into default, that has precedence. If we recall, Argentina went into default. Some Eurozone officials, this is another Wall Street Journal article here from Washington. Aaron Talley is the author. The region is better positioned than in previous years to handle the economic and financial fallout from a Greece Eurozone exit. But Thompson warned such thinking, let me emphasize, one should not underestimate the risk of a Greek exit. This has been one of the problems in the Eurozone, not only with Greece, but other economies that have long been subpar performers. They are labeled emerging economies, but you look to the Balkan states there, and of course Portugal and Spain and Italy also have not performed very well, nor had France. And we'll get to the UK in a minute. So all of these economies have their ups and downs. Eurozone, now not part of the Euro. The UK is not. A Greek financial official in Athens said technical talks about the country and its institution overseeing its bailout will resume in Paris. That was on Saturday. The so-called Brussels group includes the IMF and the European Central Bank. Now, the previous government agreed to such a measure in 2012 as part of 250 billion euros. That's 259 billion dollar rescue plan. The present Prime Minister, Alexis Tsipras, and his Syriza party argues that such an overhaul would further hurt an already suffering population. We just stated that. And there is undoubtedly a need for negotiations to gain notable further momentum in the coming days. No doubt they'll have to work on this. Back to the story of the other industrial nations. We talked about the Dow, and we'll get to that in a minute. Before the slump, the blue chip index was up 1.6 tenths. This year it's now only 3.23 points, and the year are 0.01%, following a 7.5% advance last year and a gain of 26.5%. Well, that was an anomaly within itself. The S&P declined 23.81 points. The NASDAQ composite fell 75.28 points to 4,931.81. It's a weekday, but the markets are at lofty levels. That is from Stephen Carr. He's with Williams Capital Group. He's an equity trader. He described the drop as steep, but not invoking any panic selling. Many investors remain bullish on the market, reason being growth is picking up in Europe, and the expansion in the U.S. entered its 7th year. There's no doubt about that. Ultra-low bond yields driven by expansive central bank policies. Many stocks look more attractive by comparison. No doubt. The earnings picture is starting to degrade materially, and that's making the stock market look expensive. That is from Frank Barata, and he is a portfolio manager at Sierra Investment Management. They have 1.8 billion under their umbrella. American Express fell 4.4 after saying its results were hurt by the strong dollar. No doubt about that. Reduced revenue booked in other countries. Advanced micro devices tumbled 10% after saying its first quarter losses widened as revenues slumped. We use their AMD, we use their processors. And the European bond yield tumbled again to their lowest level on record, underscoring strong demand for safe assets and the continual impact of European Central Bank bond purchases. The yield on the 10-year German bond, the benchmark portfolio managing consumer loans across Europe, slumped at 0.07, putting the debt within the reach of negative yield for the first time. The yield on the 10-year Greece bond was 12.49. 2-year yields were at 26.28, close to their highest yield since being issued. Bonds rise as bond prices fall. Yields rise, I'm sorry. The existence of an inverted yield curve where short-term debts yield more than long-term suggested that investors foresee a very high risk of default. There are concerns about the stability of Europe, and we are approaching some very critical data here with Greece. Dates, I'm sorry, that is from Jack Liu. He is at the global market strategist at J.C. Morgan Asset Management. Words about Greek come as global growth is facing fresh headwinds. The G20 acknowledge concern that likely the Fed could send shocks through the markets around the globe, an environment of diverting monetary policy setting and rising financial market volatility. Careful calibration and clear communication to minimize negatives spillovers, the group said. Exacerbating the sell-off were fears surrounding China. We'll get a little to China. The security regulatory agency issued a strong warning about its stock market tightening rules. Buying stocks with borrowed money has been a major driver of the Chinese stock market run. The market has doubled in the past 12 months. The riskiest index is up 70% this year. Chinese stocks slumped more than 5% in post-trading there. So this is some of the news surrounding the economic, where it all from the Wall Street Journal. We'll go now to the Bloomberg news. Let me just change our screen here and get the Bloomberg news up. And we try to get as many different. This is on China's their monetary easing. May not use it. This is from the central bank governor there, Zhichong, said the world's second largest economy has scope compared with other nations to ease its monetary policy. Though won't necessarily take advantage of it, we have room in reserve ratio of our interest rates are not zero yet. That was in an interview in Washington at the International Monetary Spring meeting. There is definitely room, but we need to adjust carefully. It doesn't mean we have to utilize it or fully utilize the room. Banks there, including HSBC Holdings, flagged the need for further stimulus after China's economy expanded last quarter at a slower pace since 2009. Industrial production gained in March were slower since November of 2008, an economy